Hello, can you guys hear me? Hello?
Yes, we can hear you.
Okay, okay, good. Okay, so my name is Manan Shroff. I like to do investment stuff in, there were a couple of kids, my friends' kids, they want to learn about the investment. So doing this series for them and whoever wants to, get idea about investment. So starting with the disclaimer is just because I'm going to put this stuff on the YouTube. So there is a disclaimer about that. But this is going to be, I probably have the 5 or 6 lesson, each one about 1 hour. And that should cover most of the stuff. And I'm going to have the audio video recording for that. So if you want to, we will share the link so you can listen again, or you can share with your friends and stuff like that. So without wasting the time, let me move to the let me move to the first thing, that is what is an investment? Now, according to legendary investor Warren Buffett, and investing is to lend money to receive an appropriate return on investor capital at some time in future that exceed the rate of inflation with a reasonable margin. So it's a pretty simple definition. And I just want to also tell you, if you have any question, the chat box is open. You can ask directly on that one, and I should be able to answer. So coming back to the investment, if you ask Warren Buffett what is the most important thing in order to become a successful investor, the Warren Buffett would say, rule number 1, never lose money. Rule number 2, never forget rule number 1. So, but according to me, if you ask me what is the important stuff in order to become a good investor or successful investor, especially for the kids, teenager who are listening this, the most important thing is saving. Because if you don't know how to save, you won't be able to invest anything. Because investment you can only do when you have the extra money. If you're short of the money every single time, you won't be able to invest. So for me, the most important thing is saving. And then let's look into what happened with the, like most of you are very fortunate as a kid, if you have this knowledge. We didn't have this kind of knowledge when we grew up. As early as you start your investment, it's mainly goes like drastic and profound effect on your portfolio. So let's take a look on this Jack and Jill saving example. So the Jack is only in his teen age, 20 years old. He invested $10,000, and then what he did is he's adding monthly addition of $100. Interest rate is 8% because SPY for last 45 years have averaged 8%. So let's think that way, that you're going to have the 8% interest rate, or might be a little bit more or less, but on average you will get this. And then Jill started at age 35. Same thing, $10,000, monthly addition of $100, same interest rate, and both are retiring at age 65. Now you will see the difference in the most important advantage of being early starter or early investment. Jack, this is a calculator which I used. It says monthly contribution $100, 45 years for retirement for the Jack. It's come down to around $800,000. So for Jack, it's $800,000. Just he put $10,000 15 years early, and then he started to do the $100 contribution. If you see the Jill, she did also good, but not that great. She was about $241,000. So there is a huge difference. I mean, you can see that Jack has 3 times more money than Jill. So I just want to emphasize one thing, that if you are kids and if you are growing, if you right now invest $1,000, $5,000, $10,000, and you just keep money in the index for about until you retire, you would have a good amount of money. And that's why I put these 2 slides to show you the importance of early investment. The early investment is key thing. I started investment at age of 30, which was too late. But you guys can start early. And so just want to show you the difference between these 2 people. One started early and another started late. So moving to the next slide. This slide just says that how much they make, after 65 years. So then this next slide, it says, what is the eighth wonder of the world? And that is described by one of the greatest scientists, Albert Einstein. So according to him, the compound interest is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it. So Albert Einstein also was very amazed with the way the compounding works. And we can take one small example in the next slide. So, and that will show you the importance of the compounding and the way money compounds. So let's say again, we have a Jack and Jill. We are offering Jack. We are telling Jack that, okay, Jack, we're going to give you 1 cent per day, which will be doubled. So today is going to be 1 cent, tomorrow 2 cents, then third day 4 cents, fourth day 8 cents. We're going to do this for 30 days. Or we can offer you 2 million upfront right now. Like most people will think that taking 2 million upfront would be the good idea. But because if you look, it's only a penny. It's only penny per day, and it's doubling. So if you see the next slide, it will show you the magic of compounding. So Jack, after 30 days, he would have a 5.3 million. If the month has 31 days, that amount goes to 11.6 million. Jill would have only 2 million because she took upfront 2 million. And if you see the right side of the slide, there are the days. If you see the day number 28, the Jack was still behind the Jill, because that was making him 1.3 million, where we had offered Jill 2 million upfront. But see, the big difference happened in day 29 and day 20. Day 30. That where Jack made the huge jump on his on investment. So this slide is I'm just putting here because the compounding is really has a big impact. Sometimes, many times, I mean, only small percentage, like in the decimal, 0.5% lays you on for next 30 years, make a huge difference. Make a huge difference in what you earn. So this slide should give you the idea and give you the importance of the compounding, which is very important. We can see the real life example of the magic of compounding. So in the real life example, we have this Coca-Cola. So Coca-Cola company was purchased for $25 million in 1919 by the businessman known by Ernest Woodrow. Later that year, Coca-Cola made its initial public offering for $40 per share. If you had invested $40, just $40, a single share of Coca-Cola in 1919, and if you had reinvested all dividend, what amount do you think you would have it right now in year 2022? We are just talking about $140 share. We are not talking about $10,000, $1,000 or something. We're just talking about $140 share. The current Coca-Cola price is trading somewhere at between $60 and $65. 1990, it started with $40. So this example will prove you don't have to do in investment lot of stuff right. If you just make one thing right, so out of your 21 decision, if one decision turn out good, the other 20 decisions, if are wrong, you still have a lot of money. And that's what the Warren Buffett says, that if you find it out, the business, not a stock, the business in early days, where you think that this business have a good potential, then that's what you just need it. So $40 share at around current value would be about 9.3 million. So just your great grandmother or great grandfather had put $40 in Coca-Cola share and forget about everything, other investment. And $40 was, let's say in 1990, was a good amount. I mean, it would be equivalent to $500, but still it's manageable. It's not like a huge amount where you need a $500,000 or something. So just $40 for share you invested, and it's still earning. It's still earning. Right now, it's equivalent 2022. It is equivalent to $9.3 million, and it's not going to stop. In next 100 years, Coca-Cola is going to remain here. It's very tough to now break Coca-Cola because the amazing distribution network, they won't have anyone other new members, new companies to get entered into the market. If there are companies in the other countries, they will buy out. They're going to go big and bigger. But this is the example. If you find the one right business, just one right business, you would have made the fortune. And we are just talking about one share. If you have 100 share, you can see that multiply by 100. So it's going to be 93 million. Oh no, sorry, it's going to be 930 million, 9.3, yeah. And that is a huge amount the Coke has done in last 100 years, over 100 years. We can see this another example, Berkshire. So the Warren Buffett bought Berkshire in 1965. Buffett was at that time, he was running a limited partnership. He was investing for other people. And I believe the stock was Berkshire Hathaway was trading somewhere about around $8 or $9 when he started to accumulate all the shares. And within 3-4 years, he accumulated enough money. Later on, the CEO of the company told Berkshire, because the Berkshire was a major shareholder, they agree upon buyout. And if I'm not mistaken, the buyout price was $13.75 or something like that. What happened that the buyout offer, the CEO agreed at $13.75, but he paid only $13.50, and 25 cents he did not. So what happened with that it made the Buffett very angry, and he started to buy more shares and took the control of Berkshire. If you ask Buffett, what is the dumb question? Yeah. So this is like for Buffett, if you ask Buffett right now that what's the investment he has made, and he would tell you the Berkshire. The reason why the Berkshire was not like a Coca-Cola, it was a textile mill, and we will learn more about the quality of the businesses because it makes a big difference. The $1 created by textile mill and $1 created by Coca-Cola is completely different. It's a dollar, but for textile mill, probably you have to invest 60 cents in order to get $1. For Coca-Cola, you have to invest 10 cents to get $1. So those are like not apple to apple comparison. And that's what we will learn more in the next few lessons when we go through. But I just want to give you this. So when he took the control of the Berkshire book value was $19.46. And the next lessons, we will also go through these technical terms, and there are only few technical terms you have to remember or you have to learn for investment. And some of them are like book value, enterprise value, market value, EBITDA, and we will go through that. But right now, just think about it's just think about it's a book value. It's like basically you have all asset minus all liability and divided your equity with the outstanding share. Now here somebody asked me the question, said, so would it be better to invest in company like Coke or Coca-Cola or then Berkshire? So Berkshire is now different. So when Warren Buffett took control, Berkshire was ordinary business. the ordinary business in the sense what happened that when you go to the commodities, and I always tell this to everyone who invests, that Coca-Cola can set their price. If the Coca-Cola tomorrow going to increase its price by 5 cents, people are still going to drink Coca-Cola because the earning power they have, like if you are earning about what, $50,000, $60,000 per year, you can afford $1 Coca-Cola Coke from vending machine. Coke it was a branded thing, and just want to give you one example. If you go to any supermarket, beside Coke and Pepsi, you have a choice, either Pepsi or Coke. But if you see any store brand, says CVS Cola or Giant Cola, or it would say RC Cola, and it is 10 cents cheaper than Coke sitting next to it, you're not going to pick that RC Cola because that is the power of brand. So when when Warren Buffett took the control of Berkshire, Berkshire was the commodity business. Commodity business, you can only win if you can produce the stuff cheaper than other people. In Berkshire, the industry, the cotton prices are dictated by the market. Berkshire cannot say that this is the Berkshire cotton and I want to sell it little $1 higher margin than my competitor are selling. And so when Buffett took over the Berkshire was commodity business. Right now, Berkshire is not a commodity business anymore because it's not relied on the textile thing. It is relied on wonderful businesses, group of so many businesses. I believe he has, I'm not sure, but I think he probably have 100 or 200 companies, great companies earning great return on equity. Yes, and also good market.
Saturday or tonight? Oh, one.
So he's so I would say to the Dia that the Berkshire and Coca-Cola, you can invest in anyone, because right now both are.
Thank you.
But I think somebody, can you please?
How are you?
Your voice, it's disturbing other people.
11-9.
Hello. I think someone needs to mute their voice because it's disturbing other people. Okay. So when Warren Buffett bought Berkshire, the book value was $19.46, which was in 1965, and now year is 2022, and he multiplied so the $19 to after 57 years, $345,368. It compounded around for 57 years. It compounded at the rate 18.72%, and that's why people call him the greatest investor in the world, because no one has able to achieve that for 57 years. I mean, there are people who have done for 10 years 25% return. There are people who have done for a couple of years, like Peter Lynch, one of the best Fidelity Magellan fund manager. He had achieved at about 28%, but that was just for 14 or 15 years. But if you think about the span, like 57 years, and if you are converting, it's a huge thing. So this is the Warren Buffett real life example. Now, here what I want to show you is how to calculate the compound interest. Many of you probably don't know, but just to compound, you can search anywhere on a web, search about calculating compound interest using present and future formula. So this is the calculator I use. I can post the link of this calculator in the chat in the our Berkshire. I'm sorry, in our investment learning group. But what you do is you see the present value. So for us, the present value is going to be $19.46 because at that time he took control over Berkshire. We don't know the interest rate. That's what we want to find it out. We have a period. So you put 57 years. Compound frequency, you put 1 year, yearly. And the future value, which is the correct right now, what is the book value of the Berkshire? And the current book value of the Berkshire is $345,368. So that gives you the interest rate or compound interest rate of 18.72%. So he compounded money about around 19%. It used to be 20 or 21%. It's been reduced in past decade, but it's still huge. And to figure it out how huge it is, if you go down here. So what I did is, let's say, so we find it out the compound interest using this calculator, and we found that 18.72%. Okay, so we're putting that, let's say you have invested $10,000. So we're going to put the present value $10,000. We have now interest rate, we know 18.72%. We know the period, which is 57 years, compound frequency yearly. That would turn your $10,000 to 177 million. So if you back in 1965 by chance have invested, it's $10,000. If you just think about $10,000, you convert it into 100, you would have right now $177 million. His aunt, some of his relatives, some of his neighbors, they have put over $100,000 when Warren Buffett took control of the Berkshire. So you can imagine how much money they would have now. That's why it's also called the greatest investor in this lifestyle. So what we're going to do now here, we're going to do the exercise here, because I want you guys to find it out the value of companies. Like if you have invested $1,000 in Microsoft when initial public offering came, what would be its value right now in 2022? So this also give you this is the first step towards our investment thing, where we're going to see, we can quickly find it out that if we are investing in particular company, what kind of return that company has earned since its IPO. And so I'm going to show you, here's I have put the slides, but I will also show you directly. So you have to go to the Yahoo Finance. And we are going to do for Microsoft. Okay, so if you go and if you type Microsoft, so you will come to this page. Okay, so once you come to this page, now you can do this for any company. If you have a calculator, like I have the Texas Instrument calculator, which calculate the future value, present value quickly, give you a quick idea. So you can do basically for any company where you want to invest. And the company has been there for 20 years.
I said I don't want to.
vontade de essa hoje. ખાલી હંભળ્યા કરવાનું.
For this, what we will do is you have to go to the historical data. Once you go to the historical data, you have to go to the time period and select next. So basically, it will show you from 1986. And the frequency, what you do, don't select daily because it will take too long to display the data. I would go with the monthly. Okay, and then you just apply. Okay, now what you have to do is you have to scroll down all the way.
No. Yeah, that was at like 12.
Okay, so once you scroll down here, it was April 1, 1986, the first time Microsoft started to trade. What you want to see is this column. This column show you the adjusted price. So basically, the adjusted price means if you are invested in the Microsoft at that time, that would have cost you 7 cents per share. Then what you want to do is look the current price of Microsoft. So current price of Microsoft is about $260. So what we can do here is if we go to the calculator, I will show you the calculator, but you can use any calculator. Let's see. Okay, so present value, remember, we have to put 7 cents because we want to find it out interest rate because we don't know what Microsoft has on. Okay, year. So we have from 1986. So let's say 2022 minus 1986, 36 years. So you put 36 years here. We are compounding yearly. We want to find it out the future value. We want to find it out the percentage. We know the future value. The 7 cents was the present value. The future value is today's price, which is $260. We're going to put $260 here. So Microsoft, like it's better than Berkshire also, has converted, give you the compound interest of 25.65%, which is huge for 36 years. Now, now what you would do is you have the percentage interest rate. You want to find it out what happened that in 1986 if you had invested $1,000, and for that what you can do is just change the present value to $1,000. This time we want to calculate the future value. So the future value would be length 25.65. So this would be about the compounding. So if you have invested $1,000, that would be worth of what, 3.7 million. And the future value is not important. What is important is the interest rate, how the given company has compounded. So whenever you want to purchase invest any company, for example, Apple, if someone tells you, oh, Apple is very good company, buy it right now, you want to see first, what is the compound return it has produced since it was IPO. And that's give you very good foundation for selecting the stock. If you pick any other company, the compound interest would not be as high as you see with the Microsoft. That would be, remember the SPY on average has earned 8%, and Microsoft is earning 3 times more every year. So this is the first thing you want to see whenever you want to invest in any company. If it's brand new company, you cannot do this calculation because it just came into the market. But the companies like Walmart, Apple, they've been there for quite some times, and you can do that. So I'm just going to show you again. What you have to do is you have to go to Yahoo Finance, put the symbol, and then put the symbol and then click on historical data. On historical data, select the maximum period, select the frequency monthly, and then apply. And then go all the way, scroll down. This is called adjusted close. That's the figure we want to learn. So if you scroll down all the way, we know that adjusted close for the April 1, 1986 was 7 cents. And from there, you can figure it out is what is the percentage it's earning, the company is earning. Okay. So before we finishing, I'm going to also put this PDF on the WhatsApp group, WhatsApp chat. But so this is the exercise 1 showing the calculator. What I did the snapshots of what I want you guys to do when you come next Wednesday. Just calculate the value of $1,000 invested in following companies at IPO to its present year 2022. You're just going to follow the exact same principle what you do for the Microsoft. Find it out the values, find it out who is earning the who did earn the most per year interest or compound, who has given the more rate of return in the given time span. This would be very good exercise because whenever you are interested in purchasing stock or any company, this is the first steps to do. First step, you want to find it out that company has produced a good return on investment, because there are many companies, and sometimes it happens that those many companies, they are nice companies, they're good companies, but they don't produce good return on investment. And you don't want to have one of that in your portfolio. So this exercise will give you a lot of like as soon as you want to do any investment, just go through, this is the first step you want to do. Before going of the quality or quantitative analysis, first step you want to do is this, and try to find it out how much rate of return on invested capital has generated by company. And so with this, what I'm going to do is I'm going to open up, if you have any questions. Let's see if you guys have any question, I can answer them right now. And then we will again meet on next Wednesday about same time. So let me open up here. Okay. Let me invite, hold on, let's see how I'm going to participate. Hello, Tia. Can you hear me?
Yes, hello.
Hi.
Thank you so much. This is very interesting. I just had one question.
Sure.
For this exercise, you said it wouldn't work on newer companies. So what would you say is the specific time range for us to be able to do this?
So you want to go for the IPO, the price, the day then they were listed first. So for example, for Google, you can go back up to 2004. So that's why I showed you that you have to hit that maximum button. So automatically what Yahoo Finance will do, that it will take you to the IPO day, and whatever the IPO price was that day, and that IPO adjusted close price, that's what you want to find it out. And from there on, you just have to find it out the interest rate.
Sorry, I don't think I was clear. So you're saying that the company was on the market for almost 20 years, but so like, what would you consider a newer company? When would this exercise not work? Like, when would the IPO be?
Okay, so Rivian. I mean, if you see Rivian, it's a new electric car company. Tesla, I would say Tesla also, but probably Tesla is now 5-7 years is theirs. But any company has a like IPO within the last 1 or 2 years, this exercise won't work, because you don't know their future earning power. So these will work good for stabilized companies, 20 years, 30 years, 40 years. That would be the very good time range. If they have consistently produced a high rate of return, as you've seen with the Microsoft, it's been producing 25% rate of return per year, and it's amazing. So you can also know what kind of company you are getting into.
Okay, thank you so much. That makes sense.
So if anyone have any question, yeah, just ask other. If you have any question about also the presentation, you can ask me. Yeah, well, the Prihan has sent a chat message that can you send link for this PDF so we can review it. Yeah, what I'm going to do is once we finish this, I'm going to put the whole link of the PDF. Let me see if how can I do that. I may have to do. I will figure it out how to do that, because I don't know if I can attach here and you guys can get it. Let me see. Cannot attach here. Yeah, I have to find it out the way then, because I can paste the link. I probably I have to do something like Google Drive. Right in the
You can open WhatsApp on your computer. Just mirror it from your phone, and then you can paste the link into your computer. And
Okay,
yeah.
you can do right now. Hold on. So I think this should be, you guys can now probably download it. This should be available to you. So anyone have any other questions? I would be happy to answer. Yeah, just don't feel shy asking any question. No question is stupid. So it always good to ask a question if you have any doubt. Okay, so it looks
Hey-
like.
Hey Manan, just one quick question actually. So for, let's say for Microsoft, you calculated the rate of return over a period of it's been what, 24 or 34 years, and it's the average rate of return. But I mean, as the company progresses, the rate of return gradually decreases, right? Like, so is that something you'll cover later on, or is that something to be mindful of as well? Like
Yeah, I mean, yeah, that is true because Microsoft is right now in the mature mode. But just what we want to get idea is if the Microsoft can produce the 25% return. Just think about last 10 years. If you think about last 10 years where risk-free interest is almost near to zero or 1%, and you have this company that's been earning 25%. I mean, it's a huge accomplishment. It means that the company, so it doesn't matter with with like, because many times what's going to happen that in 1986 you didn't know that this is going to be very, very successful company. So what would have happened that first 3 years it would have a great growth, and then later on the company bankrupt. There were probably many companies like that. What I want to do is when you try to see any mature company, and when you want to invest in any mature company, you want to see the rate of return it has produced for the given lifespan of that company. Because I mean, so in the portfolio, yeah, definitely you would have the mature companies, and then you have a growth companies, and then you have the small cap. That's a different story. But when you are inquiring about or researching about mature companies, this is the very best way to figure it out how the company has done. And you will be amazed because many times what happened that every and each company in investment life cycle has a stagnant period. So for example, see this Microsoft, okay? And that's why you have to see the long-term, not the short-term things. So if I go to this chart here, okay, and then I go to the max, okay, all right, let's see, I can change here, date range. Okay, I want to show you one thing here. Microsoft on December 2000, year 2000, was trading around closed at what, $21? Closed at $21. Okay, so it reached the high peak on June 2001. The price was about $36. Look how many years it passed to break that price level. So if you see from 2001 all the way, you go here. So it passed, it break that resistance after 14 years. So during those 14 years, Microsoft has done nothing. Because if you have invested in 2001, $36, you would end up on 2014 with $36 and plus dividend, whatever dividend is started to pay you. Apart from that, Microsoft has done nothing. So there are always going to be stagnant period. Some stagnant period are like this. Then Satya Nadella came, and you will see now difference. Now the people are perceived that Microsoft is again the growth company. So if you go here, 2014, it was here $37. Now Satya Nadella took it to $336. So it's a growth. Yeah, it's, you need to see the growth, but there are times where Microsoft was earning more every year from 2001 onwards, but the price was not reflecting because probably the market has overvalued it before in 1990 decade to give him high rating, and it took Microsoft 14 years to break that high resistance of $38. So yeah, we will go back to that growth thing because when you go for the growth, you have to see the how that it affects the price to earning ratio, and how fast can you recover your money. But we will do that in the next lessons once we started to valuing the companies.
Got it. Thanks.
Okay, so then we will stop here, and kids, just what I want to do is just find out those 10 companies rate of return, per year rate of return, and find it out which one is the more, which one has produced the most, and which one has produced the least. We will go over that in the next session, but these are all good companies. So you will see, I don't know, I haven't calculated. You will see the rate of return from 12% to 20% compound interest. Because these are very nice companies, stabilized company. And as I said, that there are going to be stagnant period. And that's why we have to see the long term. And in the next section, what I will teach you, the important terms on the investment, what you want to look, and we will go through that. But so I think with that, I'm stopping here. But if you have any question, yeah, just text me question on the WhatsApp chat group, and I should be able to answer you guys. Okay, goodbye.